In this video, I want to look at 4 stocks that are high on my watch list for purchasing here in the first quarter of 2023. And as you know, I'm going to be fully transparent with that. There's things that I like about these stocks and things that I don't like about these stocks. I'm going to give you both sides of that story. I think that's important for us as investors to not only look at what we like about the stocks, but to also look at what we don't like. In addition to that, one of the viewers has asked me to look at a particular stock. I'm going to do that in real time on this video. I've not researched it ahead of time, so I'm going to do that on this video so you can see how I kind of walk through that process. If you're interested in that, stay tuned. Hey guys, Kevin Burgess back again with another video. Today I want to talk about 4 stocks. These are the 4 stocks that are top of mind for me for buying in the first quarter of this year. I want to walk through the good and the bad of those stocks. Also, I want to walk through a stock with the ticker symbol HBI. It's Hanesbrands. So I want to just give you my gut reaction as I walk through that stock. Now, as you know, I'm not a financial advisor. I'm just basically giving you my thoughts, my opinions. My portfolio goals are going to be different than yours. My purpose here is to share with you the way I look at stocks, the way that I'm approaching this process. Hopefully you can use some of this and it's valuable to you. And if you like videos like this, if you like to talk about and listen to videos about dividend growth stocks, consider subscribing to the channel. I'd love to have you along for the journey. And with that, let's get started. Okay, the first stock on my list is Rowe Price. And I'm going to walk through the 5 steps or the 5 factors that I use in my financial analysis. I'm giving Rowe Price actually 5 check marks. And there is something I'm a little concerned about, though, and I'll point that out as I walk through this. But I want to kind of give you a sense around why I've given them 5 check marks. So the first area is in financial assessment. The only caveat that I have for Rowe Price is that their forward payout ratio is getting up there. It's around 70%. I like to be below 60%, but I don't find this, especially alarming given the state of the economy. And when I look at their return on invested capital being between 29 and 34% for the last 5 years, that's a pretty big profit margin. And also they have no debt to speak of, so their interest coverage ratio is not applicable. So from a financial perspective, they seem to be doing very well. Capital allocation assessment, Morningstar rates their capital allocation as exemplary. And they have had meaningful but well-managed stock buybacks over the past few years. In terms of valuation, they're at a 10% discount per Morningstar, and they're fair valued according to Alpha Spread. In the fourth factor, we're looking at the company's strategy. Morningstar gives them a wide moat, and so that to me is a good company strategy. I could go into all the details of that, but I don't want to bore you with something that you're probably very familiar with. Lastly, company management assessment. Interestingly, Rowe Price is actually run by a consortium of people rather than the traditional approach where there's really one person running it. So it's really run by committee. And I find this to be very attractive. So I have given them 5 check marks. I like Rowe Price. I am concerned about their forward payout ratio. But I think once the economy begins to improve, more than likely, from my perspective, in 2024, maybe 2025, I think we're going to see that turn around, and we will wish that we had bought Rowe Price in this time frame. I think Rowe Price works great for people who are dollar cost averaging. I don't know where a bottom would be for it, but if you're dollar cost averaging, Rowe Price is a stock that I am looking to buy in the first quarter, and it might be something you want to consider for your portfolio. Let's look at the next one, Texas Instruments. Now, Texas Instruments, I've given 4 check marks. Their financial assessment is really good. Their payout ratio is just over 40%. their return on capital, return on invested capital, has averaged somewhere between 36 and 47% over the last 5 years. Their net debt to capital is zero. They're very well run from a financial perspective, and their interest coverage ratio is around 50. Anything over 8 is really good in my book. So when it's up around 50, it is like debt is not a problem for this company. Their capital allocation assessment, they've repurchased over 200 million shares in the last 10 years, and they've got a greater than 40% free cash flow that is allocated to organic growth. So if you want to think about this as, the free cash flow they get every year, 40% of that goes into growing their business. About 30% goes into share repurchases, and about 25% goes to dividends. Now, the only factor that does not get a check mark for them is their valuation. It's not a bad valuation, but they are currently trading at a premium according to Morningstar as well as Alpha Spread. So it may be something that you want to wait a little bit and catch a dip for Texas Instruments. Other than the valuation, I'm really good with everything else. Company strategy, that Morningstar gives them a wide moat rating. They are in the not only analog technology, but they do play around a little bit in digital as well. But they are the industry leader in analog technology. And there is a lot of expertise and a lot of capital to enter into that market. I don't see them losing that position anytime soon. Another key thing about Texas Instruments is that their chips are focused around industrial and automotive. It's about 62% of their revenues. And what that means is their chips have longer lives and they have higher switching costs than other chips that are in markets that are much more rapidly changing. And lastly, the company management assessment, they've got long-term growth of their free cash flow is 12% per year for a 17-year period. They invest significantly in organic growth. They have a dividend growth streak of 18 years. They've paid dividends for 33. They have a 5-year CAGR of 21%. I'm giving them 4 check marks with only a valuation yield sign as a little bit of a caution. Now, moving right along, the third stock I want to talk about today is Lowe's, ticker symbol LOW. I've given them also 4 check marks. There is a yield sign on what the capital allocation assessment. I'll talk through that a little bit. In their financial assessment, their forward payout ratio is around 30%, really good. They've got a 25 to 50% return on invested capital over the last 5 years, and that's per year over the last 5 years. Their interest coverage ratio is around 12, so they are managing their debt very well. In terms of capital allocation, there's something that's a bit concerning to me, and that they have had significant share repurchases, and so much so that it's driving their equity balance negative. Their debt is also high at 0.94, so they may be possibly financing share buybacks with debt. I'm not really keen on that, so I've put a yield sign on the capital allocation assessment. I'm not sure that's a huge deal, but I do want to make sure that when I see something like that, I want to point it out to you so that you can look into that further if that's an issue for you. In terms of valuation, they're at a discount for both Morningstar and Alpha Spread. The company strategy, they get a wide moat rating, mainly around their distribution and economies of scale. So that gets a check mark. Company management assessment, they have an excellent approach at managing and marketing to their target audience. They established their moat and continue to defend it. This is a strategic competitive advantage for them. And they have a 61-year dividend growth streak. That is really impressive. So I'm looking at Lowe's to increase that position in the first quarter of this year. I'm not too concerned about the capital allocation issue, but I do want to point it out as something to keep an eye on. The fourth stock I want to talk about today is Parker Hannifin, ticker symbol PH. Their financial assessment is actually really good. Their forward payout ratio is around 27%. That is awesome. Their return on invested capital, 12 to 18% per year, is really good. and they've got a decent interest coverage ratio. They're able to cover their debt very well. In terms of capital allocation, their balance sheet's sound. Their debt's a little bit on the high side, but again, we saw that they can cover that really, really easily. Valuation, they're trading at a discount for both Morningstar and Alpha Spread. Their company strategy, they're an industrial conglomerate with significant economies of scale. I think that's important. Now, I've given them a yields sign on the company management assessment, mainly because they've recently installed a new CEO. We need to see how this person's going to lead, how they're going to manage, how they're going to run this company. So it's not not something that causes me concern, but I do want to point that out, and I want to make sure that we keep an eye on that as we move forward. So those are 4 stocks that I'm going to be looking at to add to my portfolio in the first quarter of 2023. I believe those are 4 solid companies that are going to perform well in the long term. And the last thing I want to do today is talk about a company called Hanesbrands, ticker symbol HBI. Had someone ask about this in the comments from my last video. So I thought I would just kind of do an off the cuff, an analysis of HBI. So here we go. So the first thing I typically look at is my Simply Safe dividends. They have a tremendous amount of information in here, but let's kind of walk through Hanesbrands. So first of all, they've got a dividend yield of 8.31%. That's pretty high. That means that there's usually something that's going on with the company, and investors are reticent to actually invest in it for the future. They have a dividend safety score of 20, which is actually one of the lowest I've ever seen. So that's a very unsafe dividend rating. They've got a 0% dividend growth. Who are they? They are a consumer goods company. They design, manufacture, source, and sell a range of basic apparel for men, women, and children. So we know that this is going to be in the apparel industry. The company operates through 3 segments: innerwear, activewear, and international. Let's move on then to their dividend growth. You can see that starting in about 2017, their dividend has been flat. It has not moved upward at all. They've paid a dividend for about 8 years, but they have grown it. They stopped growing it in 2017. Simply Safe Dividends says that this investment appears speculative, and so far I would agree with that. Now let's look at the payout ratio. It is climbing into the 75% range. However, it's interesting to note that their free cash flow payout ratio is negative. And what that typically means is that their free cash flow is negative. Their earnings per share is dropping. Their free cash flow per share, here it is negative. And again, I'm just giving you my off-the-cuff reaction here. It looks like they have been doing some share buybacks, but not much recently. Their sales are kind of flat. The return on invested capital is not too bad. It's in the, anywhere from 14 to 21%. So that's actually not a bad return on invested capital. Their debt is really high at 0.86. That means that 86% of every capitalized dollar is debt rather than equity. And their interest coverage is well below the 8 that we look for. It's at 5.25. So they're probably struggling in the area of debt. So the next thing, let's go and look at the valuation here by Morningstar. Morningstar gives it a fair value of 22. Its last close was at $7. So they are at a 67% discount. And when I look at it on Alpha Spread, they are valuing it as at 16, which means they're at a 55% discount according to Alpha Spread. Let's sneak in here to Seeking Alpha. Take a look at some of their financials, their income statement. Let's look at their earnings. Yeah, their net income is really low. It was actually negative in 2021. So they're struggling a bit in terms of making money. Let's look at their balance sheet. They've got about $250 million in cash, it looks like. Let's look at their debt. They got long-term debt of about $3.7 billion. So they're straddled with a lot of debt. That's usually not a very good sign for a company that's struggling with these supply chain issues, inflation. It's going to be a tough thing for them. But let's keep moving. Remember, there's 5 things that we look for. We look for financials, we look for capital allocation, we look for valuation, we look for a strategic plan, and we look for the management. So let's keep going. Normally, I will go out to a company's website and look at their PowerPoints and that they come up with to help describe what their strategy is and where they're heading. There is nothing out there like that for Hanesbrands. They did have a frequently asked questions out there. This was the only investor presentation other than, just their normal SEC reporting and their earnings releases. And none of this really applies to strategy. It's really about, hey, here are the things that we're doing. It seems like they are focused more on tactics than on strategy to me. But to look a little bit further, let's go on to their 10K. This would be their 10K from last year. So let's skip on down then to the overview. They basically say that they are a socially responsible leading marketer of everyday basic innerwear, activewear apparel in the Americas and some other places under some of the world's strongest brands. So, but what does that mean? How does that give them strategic competitive advantage? They design, manufacture, source, and sell a broad range. Okay, anybody can do that. Then it says our operations are managed and reported in 3 operating segments: the innerwear, activewear, and international. So that's good. So let's look at some of their trends here. They've got inflation and changing prices as a trend. That's a challenge. They've got other business trends here. The basic apparel market is highly competitive and rapidly evolving. That's not a good thing. They've got foreign exchange rates. We know about that. And so then they say, what are our key business strategies? So this is kind of where we would say, how do they articulate their strategy? Their strategy integrates their brand superiority and industry-leading innovation and low-cost global supply chain to provide higher value products while lowering production costs. The challenge here is that regardless of how industry-leading their innovation is and how good their global supply chain is, it's not going to be able to compensate for all the issues that are in the global supply chain today. I will give them the brand superiority. I think Hanes is a household name. It's a name that we've seen Michael Jordan advertise with years ago. Other than the brand superiority, I'm not thinking that their innovation and low-cost global supply chain is really adding much to their strategy. So I think on the strategy side, I would probably give them a yield sign on that. Now, it's hard for me to assess the management team without listening to earnings calls. I'm not going to do that here on this video, but I would consider the fact that they don't have PowerPoint presentations around what their strategy is and what they're trying to accomplish and how they're going to get this ship back out in the right channels. I would say since they don't have that, they're probably not doing what they need to do. So financially, yield sign. Capital allocation with a negative free cash flow, they need to be cutting their dividend, and they haven't done that yet. Yield sign. Valuation, that gets a check mark because nobody's wanting to buy it. Fourthly is their strategy. I think their brands are a good strategy, but I don't think their global supply chain and innovation, at least from what I've seen, is really coming through as a strategy. And so I give them a yield sign on the strategy, and I also give them a yield sign on the management team. So basically this gets 1 check mark. So, is it possible to make money on this? Absolutely, because it is so undervalued. Any kind of positive news could shoot the stock price back up. So hopefully that's helpful to you. I thought it might be fun just to kind of go through and walk along with me as I looked at that stock. So with that, I'm going to get out of your hair. I hope you have a blessed 2023, and I'm looking forward to what this year brings. And I'm so glad you're here to walk with me through this journey. So with that, I'll see you on the next video.